All right, good afternoon, everyone. Thanks for joining us today. This is Adam Newman. I'm a partner and senior wealth advisor at the firm, and I'm joined here by my colleague, Bijal Patel, also a partner and a senior wealth advisor with the firm. And we've put this webinar together in response to some of the volatility that's been happening in the market over the past few weeks. And although this is outside of the cadence of our typical quarterly webinar, we thought it'd be helpful to just really tackle some of the big questions that we're receiving from clients and provide some reassurance and context and start to lay the groundwork for what we see in front of us. So Bijal and I are going to try to make this just about a 30-minute conversation. And what we're going to do is we're going to go back and forth across really three different topics. First, we're going to tackle just what's been happening over the past, really from the start of the year, but specifically the past, few weeks. And what does that look like when we compare it to previous drawdowns in the market? How that might provide some hope for the future for a recovery and what that looks like historically. And then finally, just some actionable things that we're looking at and that we think our clients should be looking at. So, hopefully this is educational. This will also be recorded for those that are not able to attend and post it on our website. But, Bijal, we're going to jump right in and let's go ahead and as planned, go ahead and give people just an update for what's been happening so far this year.
Yeah, absolutely. I think a lot of people have been catching in the headlines, right? Especially in the last week or so, that the markets are in a free for all, going directly from a correction phase into a bear market. And I think what's important to understand is putting this in context in terms of what has led us there. So different segments of the market have drawn down a lot faster, and I kind of put some attention to what the NASDAQ has done, because that's really one of the indexes that kind of led us on the way up, and it's also been leading us on the way down, down over 27%, not including kind of today's market movement itself. But that's what really caught a lot of people's attention. Some of these large growth stocks that have been selling off and kind of their drawdown that we saw so far this year. But relative to other indexes also, they've kind of definitely gone into correction phase. I think what many people also pay attention to is the S&P 500, which is large cap stock weighted, not quite in bear market territory, but down 17%. I think it's important to understand when you look underneath the hood within the S&P 500, that there's a segment of growth stocks and value stocks. They've performed very differently within the indexes themselves. Growth is really what's let it down. Value has been kind of holding up strong in terms of still down, but not down as much as the overall market. So what you can see from this screen here, though, is that it's pretty obvious. From the beginning of the year, kind of all segments of the market have gone down, both US, international, and when you take a look at kind of a couple of the other asset classes, REITs and bonds. I think what's interesting to see with bonds, though, this is probably the first time that many people have seen both equity market and the bond market go down at the same time. Typically, they kind of move in an inverse relationship. But this is important to understand the overall allocation within the portfolio and understanding why these movements have been taking place. So with that, in terms of what's been causing the sell-off, Adam, you want to kind of just talk a little bit about that?
Yeah, I think the main headline, especially the last couple of months, what people have been putting a lot of attention on is inflation. And if you go back, post financial crisis, we really had a 10, 11-year period of no inflation. I mean, if you go back historically, on average, inflation runs somewhere in the neighborhood of 3% per year. So we had a really nice window of time where we were well below that. Inflation was essentially zero. And to go from that to something that's been a little more stubbornly around the 8%, 7-8% range year over year from an inflation standpoint has caused a little bit of alarm. And people are asking that question and debating, how long is this going to linger? At first, it was, this is purely a transition that we're going to go through as a result of what happened in 2020, the money printing that occurred, and we just have to ride out this short-term rough patch of high inflation. And now that's turned into a little bit more of a question mark of how long is this going to run. I think still the general idea is that we'll plateau somewhere around where we are, and then toward the end of this year and early next year we'll get maybe not back down to to 2 or 3%, but something much lower than this, going forward for a period of time. So inflation's the big piece, and then in tandem with that, with inflation, we've got rising interest rates, and so the Federal Reserve is very closely watching both of these things. Rising rates naturally happens in inflationary environments, and the big question now is just, how much are rates going to rise and at what pace? And we've been fooled several times, Bijal, right, over the last 10 years, waiting for rates to go up. Bond investors, especially, and stock investors have been playing this game of chicken. When are rates going to go up, by how much? And we've had several instances where there's been a short-term spike and then a quick reversal. So, I think that's something that the Fed is trying to figure out in terms of by how much they want to raise rates and when and at what scale. That coupled with inflation, those two things I think are the main, a main piece of this that everyone is watching. And then Bijal, I know there's two other points here you really wanted to address as well.
Yeah, and before I get to those 2 points, I didn't just say in regards to interest rates, the pace is really what's catching headlines these days. I think everyone is expecting the Fed to increase rates throughout this year, and now, especially with the most recent Fed meeting, having a 50 basis point raise, but now reading into between the lines, will they be more aggressive, right? We just don't know, and that's the uncertainty that the market has kind of been pricing in over the last couple of weeks in terms of the volatility that we've seen. But I always say that there's more than one or two things to worry about the market at any given point in time. A couple of other things that's created the volatility in the marketplace is geopolitical risk. Right? When you think about what's happening between Russia and Ukraine right now, I think when the conflict first started, many people thought it would be short-lived. But here we are, and I don't think there's any resolve on the horizon anytime soon. But with that, the early days of the conflict, and when it came to the U.S. market especially, I think people came to take a look at the overall impact on Russia and Ukraine on the U.S. economy is very minimal. However, the longer this is drawn out, now people are starting to take a look at, what happens when it comes to food, especially wheat and corn coming from Ukraine. When you take a look at Russia, energy exports to European countries, and if that is to be disrupted for a long period of time, that would have an impact globally, and what level of impact. The thing is, we just don't know, but I think those are the things that people are speculating around the geopolitical events. And then the last point, to talk about is the sell-off in growth stocks. Ever since COVID, I'd say that that was one of the areas that was kind of leading the recovery, and even pre-COVID. Many people and the weightings that we saw within many of the indexes heavily weighted to the top 10 names that were really growth stocks, right? So they were really leading the charge in terms of what the market was doing. And then as part of that charge, I think there became a secondary market that people were investing in. And that was kind of, this new economy that's being created through staying at home, right? Because we went from overnight, essentially, right? From working to everyone staying at home and now trying to figure this out. So as part of that, I think what we were able to see is the stay-at-home economy, that there were certain types of companies that were predicted to do really well. We just picked a couple here that we wanted to share with the group today, but Peloton and Zoom, that's the meeting we're having today, right? I think about Peloton. I know, Adam, you've got one of those bikes. You got it well before the pandemic, right? But everybody was racing out to get one of those during the pandemic. And now that we're back in the gym, a company like that, you see the challenges that's running across. Zoom, the technology, we're using it today, right? It's going to be around. I think the early days of the pandemic, it felt like they were the only ones that had that technology. But in terms of doing video conferencing, there are many other companies that now offer it. So you can see that the struggles that they're going to be having. And then a couple other kind of just components that are taking a look at cryptocurrency and Coinbase and the ARK Innovation Fund and Cathie Wood's strategy itself. But what's interesting, if you look at this chart, is those strategies are down anywhere between 50 to 75% just year to date. And the problem with this becomes is that when you have in certain investments and you're overweighted in these types of investments and they have this type of decline relative to the market itself, if you're down 2 or 3x the market, it becomes very difficult to try to recover your losses. And again, when it was working, everybody thought that there was going to be no shortage of new innovation. These stocks are going to the moon. But in reality, at some point, I do think investors do want to focus in on fundamentals. But this all goes to show that we've seen things like this before. We've seen events where the markets do go down. And I think it's pretty interesting to take a look if you look back the last 10 years or so, different types of events that we've had and the types of drawdowns that we have occurred.
Yeah, and this is something we shared. We shared this almost exact same chart during one of our early webinars in 2020 when we were addressing the volatility from COVID. And this specifically is looking at those drawdowns that we've had in the market that were 9% or greater really since the great financial crisis. And there's about 14 of them. And what this is trying to illustrate is, the timing around when these drawdowns occurred, the number of days that the drawdown transpired over, and what the percentage decline was tied in with what was the story at the time. And, Bijal, you hit on it a little bit. Anytime we go through both a really good market or a really bad market, investors do what they naturally want to do is try to explain it. So they attach a story to it. And if you look on the way up in 2020, the story was the world's changing. There's a new economy, a new regime in place, and these companies are going to lead us into the future. And so we saw excessive valuations and really a lot of euphoria. Now we're just seeing the complete opposite. So we're coupling that rotation from growth to value along with the concern around rising interest rates and the other, topics we pointed out, a little bit earlier. So, and this is, what Bijal and I were talking about this earlier today. We'll continue to stack to this chart, right? This will happen. It's a natural course over the natural course of the market. These both corrections and bear markets will continue through time, and each time the headlines are going to be scary. And that's something we're prepared to address. But we wanted to just highlight some of the main events that have happened and what the impact has been. And so obviously in this particular sell-off to start this year, it's been a little bit longer. If you look at the average drawdown since the great financial crisis, has happened over about 2 months. This has been, a little bit, past that. So it's felt, a little more ugly, and it's also been slightly more severe in terms of the percentage drop. And obviously with some big up and down days, along the way. And so, but with that, this is, again, as we pointed out time and time again, part of the natural, orderly, positioning of the market over time. And so if you look at that, you take that same exact time period and you look at, well, what is the market return since the great financial crisis? It's still a substantial, total return gain over that same time period. So I don't think anyone here would debate the long-term attractiveness of stocks versus other investment categories, especially when you factor in things like inflation. And, most things in life have a cost, and the cost of investing and reaping the benefits of stocks over time is some of these painful periods that we have to go through. So Bijal wanted to put that in a little more context in terms of looking at prior bear markets and their recoveries and what they look like before we start to jump into some actionable items that we can take on forward.
Yeah, and Adam, off that slide that you just showed, so when you're going through any one of those drawdowns, right, it seems like the world is never going to stop and the market's going to go to zero. But I wanted to take a broader look here, almost going back the last 100 years of just kind of taking a look at bull and bear markets and how long they last and some of the characteristics that you see. And in terms of bull markets, you see that the markets do go up and they go up quite a bit. But when we go through those drawdown periods, they tend to be shorter in nature, but they're very natural. And I think one of the questions we get a lot of today has been, is this similar to what we saw in the tech bubble of the early 2000s, right? So we had growth stocks and technology stocks in particular leading the way, and then the bubble burst, right? And that for many of those tech stocks, it took over a decade, if they were able to recover, a decade or two to be able to recover. And people are asking, is that similar to what we're experiencing today? And I'd say one of the difference today is with the tech stocks is that they're profitable. They may still have high valuations, but they're profitable versus in 2000, with a lot of the companies not being profitable, they actually went out of business themselves. So that's something that's a little different today. And also another observation from here, which is hard to see on a day-to-day basis, is kind of just the numbers, right? I like to say kind of within our firm, we're always crunching numbers and talking about numbers. It's just general statistics about the market and its behavior is what you'll find is that the markets go up about 70% of the time, but people really get fixated and focus in on that 30% of the time when it's going down. So really having a longer term view, I think is important. And then really the hard thing to do is trying to look through what's going to happen once we get past this kind of recovery phase, right? So in looking at historically, what are the returns like within a portfolio once we get past a 10% drawdown? And what's kind of amazing to take a look at is that, again, if you can have the discipline to sticking to your strategy, what a recovery looks like. And here what we're looking at is kind of just some numbers around a 1, 3, and 5 year return after we've had a 10% or more drawdown within a portfolio. What's really interesting is that 1 year later, the markets on average have been up about 11.3%. I think one of the things we've seen is that some of the best days in the market come very soon after some of the worst days in the market. But when you're experiencing that initially, sometimes your emotions kind of get in the way and you want to make a change based on what's happening today. So again, I think it's important to kind of keep a long-term focus as we do in terms of being fundamental investors. And there is a recovery that happens behind this.
And one of the things, Bijal, that we tell clients all the time is, and this is just the psychological aspect of it, is every past bear market looks like an opportunity, and then every bear market that you live through going forward feels like something a lot worse. If I ask anybody, would you have been willing to stick out or even add money during the COVID sell-off or the great financial crisis, I'd probably get a lot of excitable answers. Like, absolutely, right? Like that's when things got bad before they got a lot better. And so over time, we know that things will continue to repeat themselves in a similar fashion. It's just the timing of when that happens. And again, going back to the story piece of it, the story each time will be different. 2020, we were telling clients, now we're talking about a potential depression. We're talking about uncertainty around when the economy will even reopen. Now we're talking about something completely different. And then next time and the time after and the time after that, we'll be talking different headlines.
Yeah, absolutely. So in terms of, when you're in a situation like this, Adam, you want to talk a little bit about, what should investors be doing right now?
Yeah, and I think we're going to break this out. We're going to focus on some key questions you should ask yourselves in a tough market environment, and then transition into what we do at the firm during these types of markets, and then what types of conversations we might want to be having together. But when you're faced in the throes of a market like this, there's really three key things and questions you need to pose to yourself. The first is, have your goals or time horizon changed, right? If you needed all the money or a majority of the money in your portfolio in the next year or 2 years, then you probably shouldn't have been all in stocks to begin with. So continuing to reemphasize the time horizon piece of it, knowing that over an overwhelming majority of 5, 10, 15, 20-year periods, especially, stocks tend to continue to trend upwards, regardless of what they face in the short term in terms of headwinds. So really reframing the time horizon and just thinking through that and reminding yourself of that. And the second is the psychological piece of this. The stock market is, several hundred years old, but the human brain has been evolving for many, many more years than that. And so in these markets, our fight or flight response kicks in, and we start to potentially fall prey to some big time behavioral biases to try and stop the pain in the moment of what's happening in terms of market losses. So there's really three behavioral biases we always like to remind clients of, to think about and making sure they're not running into any of them during a volatile market. The first is recency bias, feeling like whatever we're going through now or have gone through recently is going to continue. And this bites in both directions, right? So when you're in a bad market, it's going to continue to be really bad. If you're in a great market, it's continue to be really great. Things are cyclical. So this goes both at the market level and the individual stock level, just always reminding yourself that what has happened most recently does not need to continue in the future. Second is overconfidence. And we really see this when it comes to people trying to either time to other asset classes or go to cash. Hey, even though there's millions of market participants, even though the market knows a lot of these things are going to be happening, I can get out and stop the bleeding, and I can hop back in when I get the green light, which, Bijal, we were talking earlier, like the market doesn't ring a bell and give an all clear signal. So overconfidence and coupling that with the idea that a lot of the best and quickest recoveries happen after the sharpest and most painful declines, checking ourselves in terms of what do we really know that the market doesn't, and how do we translate that to decision making. And then loss aversion is just our natural aversion to any kind of loss or pain. And so and that trickles into these other two biases in a way that we might be prone to make some really rash decisions to stop the bleeding on what's happening and just avoid losses at all costs, even though we know the long-term benefits of sticking with the plan. And so that's really the last big piece of this, Bijal, is the strategic investment plan and having one in place. So I think you've got some really good points and examples of that.
Yeah, I think, in terms of one of the things in volatile markets like this is bringing a discipline to the table, right? And lots of times that you can always go back to your discipline when you've kind of thought about the best time to prepare for the future when things are stable, right? So as opposed to emotionally in the middle of a storm, you're trying to come up with a plan. So I think it's really important, and it helps people avoid making bad emotional decisions and kind of sticking to a discipline. And that's one of the benefits of kind of working with any one of us or our team itself. But with that, people will ask kind of like, okay, what are some of the things that we will not do? So, for those that may be new to Bernie Wealth, we've been doing this for a long time, right? Collectively, we've been in business for almost 50 years, and we do follow a discipline, especially when times get tough. And in the last couple of days and weeks, we start to hear questions again when we're in a bear market territory. Should I go to cash? I'll just kind of wait, as you mentioned. We're just like we hear the opening and closing bell every day. But there's no bell that's rung that says that we've got the all clear. So with that, right, you have to be right twice in terms of you have to be right when to sell and when to get back in. But also, what ends up happening is for those that want to go into cash, I think many people will ask us, okay, well, maybe instead of going to cash, I'm just going to make a directional bet to into a particular sector or asset class. What has come up in the past to us is to say, okay, well, what if I get on the market and I just went to gold for right now, right? That's a safe haven. It'll help me ride the volatility. And when things clear up, then I'll kind of get back into the market. But again, if we knew it was that easy in terms of when we hit a bottom and when things were clear, it'd make that a lot easier. But I think more importantly, it's important to stay invested in a strategy that takes into consideration volatility and risk itself. So in terms of what we look for when we do have periods like this, so a couple of things I talk about is when it comes to tax loss harvesting, when we have these sell-offs like we are right now, and for many of our clients, we do own individual investments and individual equities within the portfolio. When it comes to tax loss harvesting, I think a lot of people have a misunderstanding of saying this is always done at the end of the year. But really, the markets will give you an opportunity when that needs to happen. And when we have these sharp sell-offs, that's a potential for us to be able to be active within the portfolio, harvest some losses, and look for opportunities moving forward. But the other thing that happens also is a rebalancing strategy. So within our strategy itself, we have a weekly meeting amongst our investment committee team, and kind of taking a look at what just happened and what are the longer term trends, and do we need to be rebalancing? And as part of rebalancing, when we hit a bear market territory or when markets are distressed, we look at a secondary modeling system. It's not black or white to say that as soon as we hit 20%, we turn it on. But this is a time that we're having active discussions. And when and if the time is right, then we will make some changes in terms of rebalancing within the portfolio. But the other thing I think, Adam, you talked about, what can we do to kind of take control? When it comes to risk itself, what are your thoughts?
Yeah, well, I think, and one more quick point on rebalancing before we talk about risk. Rebalancing certainly happens within the equity piece of the portfolio, but for those that have some sort of an asset allocation, say you've got some bonds, some equities, and maybe some other asset classes. Something we're looking at is, when these sell-offs happen, your target balances for each of those categories becomes out of whack, right? So maybe your stocks now are a little lighter relative to where they should be. Maybe your bonds are overweighted. So these periods naturally become a time where if you have a plan and a strategic allocation, you can sell things that have, either become too large of a percentage of your portfolio or have even risen in value, and you can, sell those and then buy things that have become depressed and are on sale. So I think you certainly explained the equity piece of that, and then the asset allocation end of it is something we're really actively looking at. And then, for those that don't, we don't manage their asset allocation directly, we would advise strongly that you look at that. And then when it comes to risk, risk really, and your risk profile really reveals itself in these kinds of markets. And in 2020, we had a lot of conversations with people that woke up one day and said, you know what, my life is about to change. My tolerance for this type of volatility is a lot different than I thought it was before. Let's make a change and let's reduce our risk or find something that's more appropriate. And those clients are holding up really well now because, they're experiencing another tough market, but in a place where they feel a lot more comfortable. So the amount of risk you take should be driven by two things. The first piece, which I just explained, which is how your gut reacts to these markets and how you might feel compelled to make certain decisions. And then the second piece of that is what's the return you really need to generate long term to meet your goals. And if your portfolio requires let's say, for example, a 5 or 6% return to do what you need to do, your portfolio could look a lot different than someone who needs an 8 or 9% return. Don't force yourself into taking too much risk if you don't need to. And that's something we have a lot of conversations with clients around, right? And that's part of this communication piece, Bijal.
Yeah, so in terms of that, also what we see a lot of is this whole concept of being all in or all out, right? I think I've said that quite a bit, and we kind of joke around the office itself. Is that I think a lot of people feel the need to be able to react in one way or another, where having the right risk profile, having a question about what you feel comfortable with in your long-term goals, will allow you to avoid making those emotional decisions of either being all in or all out. And communication is important, right? We do this frequently here in terms of when the markets again will dictate how often we need to kind of talk about what's going on, give you our opinions. But in terms of what to expect in terms of strategies moving forward, I know that we constantly are either doing a blog post, doing a webinar, doing quarterly updates. But looking backwards, I think we could ask you, say, look, some information doesn't change. You might find some of these things we've highlighted in past blog posts. But Adam, I want to just talk about what will help you during a time of a sell-off itself.
Yeah, this really summarizes a lot of the previous points up. And this is pulled from a blog post that our director of investment strategy put together a while ago that we've just continued to repurpose. As history repeats itself, strategies for dealing for current and future market sell-offs. The first big thing being, as we've highlighted several times already in the past 25 minutes or so, really expect volatility. It comes and reveals itself in different shapes and sizes over time, but absolutely expect it as a stock investor or someone who's participating in any kind of growth market. It's the price we pay, right? Like a lot of things in life, as I said before, have a cost associated with it. The price we pay for those higher returns over time, and especially returns that outpace inflation, are the big swings that happen, periodically that we need to ride through. The second is today, it's hard, I know, with our phones and quick access to information. It's, come up with a cadence for checking your portfolio that feels comfortable to you. And mainly to avoid over checking or frequently checking can certainly help. Great example, I was out on vacation last week. I came back and saw that the market was down 0.5%. And that was the story for the week. But if you were living through each of those days, you would have seen something much different. Right? We had big up and down days, 2-3% up and down. And that's certainly a short window of time. But the more you check and the more you subject yourself, especially in these kinds of periods, to looking at your portfolio, you're just going to bring forth those pain points probably a little more than necessary. And as Bijal said, these all or nothing decisions, and it's some of this comes down to, I think, to just how people view the markets in general and knowledge, but the idea that it doesn't need to be an all in or all out call. And we're here to coach you through what should your allocation look like? Should you be taking the amount of risk you're currently taking, or are there changes? Bijal, it's not all cash or all stock, right? I mean, you've seen that plenty of times. And we've all had that conversation around it. There's a spectrum in between that and an appropriate way to look at that we're here prepared to help you with. And that's part of the talk about it piece. We're certainly don't want any of our clients to be in this, alone. And while these webinars and blog posts and things like that are meant to be helpful and educational, nothing beats, that one-on-one communication, especially if you feel like you're getting more and more anxious about the volatility or questioning things or want to have a conversation. It's really important to make sure that we've got the opportunity, to do that. So, Bijal, do you think that covers that piece of it pretty well? Do you have any other anything else specific related to those items?
I think that covers it. Again, just what I'd say, specifically to anyone out there listening, right? Again, it goes back to, if you're feeling anxious, then let's talk about it, and we'll help kind of create a plan and work your way through short-term volatility to help you be successful meeting your long-term goals.
And just in terms of the cadence, the way that we approach these markets is, once we hit around this bear market territory and even leading up to it, just know we're communicating internally and looking at things. And the first thing we want to do is just address the concerns around the volatility and, provide some of these tips and give you some insight into what we're thinking. But the next phase of this really, just so you know, is, what opportunities should we be taking advantage of? And, what should we do next? These markets, whether it's something that's very severe and quick like 2020 or something that's more of a slow drawdown like we're experiencing now, part of being active managers and investors is to take advantage of these kinds of markets. So just know that we're looking behind the scenes and having conversations around timing, whether it's, as Bijal said, turning on our model specifically designed to handle market recoveries, or making asset allocation changes for those clients that have a balanced portfolio with us. The next phase of this, and really the conversation that we'll want to make personal when the time comes, is to address with you individually, what should we be doing, for the next leg of the market. But I think that's, in terms of just the general content, we wanted to keep it to 30 minutes. We know it's a late Friday afternoon. This will be recorded. Our door is open, and we'll continue to watch things. So if you feel like we need to do another one of these, or another blog post, or put anything else out there additional, please know we're thinking about that, and we're here and ready to answer and address any questions. So appreciate everyone's time, and thanks again, and have a great weekend.
Take care.